In this video, I'm going to share my investment framework as a value investor. The reason for this is because of this graph. This graph is from JP Morgan and shows the annual returns from different types of investment from 1998 to 2017. Over those 20 years, had you invested in almost any asset class, you would have made money. Real estate, gold, stocks, even bonds all returned over 5% per year during that period. But then there's this bar, this sad, lonely bar, lower than all the other returns and barely keeping up with inflation. This bar is the annual return of the average investor, 2.6% per year. How is it possible over a period of 20 years where nearly every asset class returned over 5%, the average investor return was just barely over half of that? In my view, the largest reason for this is that the average investor makes many investment mistakes, primarily due to a lack of a systematic investment framework. If that graph wasn't enough to convince you of the importance of this, let me provide you with some real numbers. A 30-year-old investing $10K per year at a rate of 5% will have just over $1 million by age 65. But let's say by implementing an investment framework to improve your decision-making and avoid mistakes, you're able to increase your average rate of return by just 1%, bringing it from 5% to 6%. Then for a 30-year-old investing the same $10,000 per year, you will have over $250,000 more by age 65, and even more if you start saving earlier or invest more money. So in this video, I'm going to show you exactly how you can build that systematic investing framework to stop making investment mistakes and start investing like a pro. From stock selection, to position sizing, to market timing, to risk management. I'm going to cover all 4 of these aspects and provide specific examples from my portfolio. Let's start with the first aspect, stock selection. If you're investing for the long term, you're more than likely going to be owning a fair portion of stocks. Stocks or ownership shares in businesses are one of the best ways of preserving and growing your wealth over time. The big question is, how do you decide which stocks to buy? What is your stock selection system? Now, generally, most people will fall into one of these 3 categories or a combination of the 3. Either 1, you use an index fund that tracks a broader market. 2, you use actively managed funds with a manager that decides which stocks to invest in. Or 3, you select your own individual stock investments yourself. We'll discuss considerations for each 3 and then bring them all back together. So if you're investing in index funds, you may think that you probably don't need to answer this question, because effectively, if you're buying an index fund, you're just investing in the index. There is no stock selection that you have to do. Well, that may be the case. There are still questions that remain that you should answer. For instance, which indexes will you be investing in? At what proportions? How much international exposure do you want? Will you add any tilts, i.e. investing a bit more in specific sectors? Will you be combining indexing with any other individual stocks? And this isn't by any means a comprehensive list. As you can see, when developing a systematic framework, it isn't always as simple as just buying the index. Without a plan, you may start off by buying a simple index fund that tracks the S&P 500. However, over time, you might start gradually branching out into other sector funds that interest you at that point in time. Multiply this process out over a couple of years, and before you know it, your portfolio is very different from the initial S&P 500 that you began investing in. This is certainly something that happened to me when I first started investing. I started with a typical total stock market index fund, but after time, I started getting interested into other sectors and funds and began investing in, for instance, utility stocks for their defensive nature, real estate stocks for their higher income, and technology stocks for their higher growth. But at the end of the day, I didn't really have a fundamental strategy for how I was selecting these funds. Now, if you're in the second group where you're choosing an actively managed fund, there are still several questions you should ask yourself. How do you select your manager and or which funds to invest in? What conditions would cause you to change your mind? Over what period would you evaluate this criteria? Also, are you sure you're getting more added value through active management than the cost of the management itself, typically in the form of an expense ratio? I'll be blunt with you, over the long term, the answer for this is more often than not no. Generally, when you're using an actively managed fund, you're giving up control for a cost in the form of a higher expense ratio, which can reduce a substantial proportion of your future returns. This is why my strategy and investing portfolio don't use any actively managed funds, and I don't particularly recommend them to investors. But if you do use them, be sure to be able to answer the questions above. And finally, there's individual stock selection. This probably has the most questions regarding building an investment framework. What criteria do you look for in a stock? Are you investing for dividends or dividend growth? Will you be more focused on value stocks, growth stocks? Do you have a preference for quality? Are you willing to buy deep value stocks, cyclical stocks, or turnaround stocks? What is your circle of competence? Answering all these questions can be a bit overwhelming, which is why most people probably start out with an index fund or maybe select an individual stock of a company or business that they know relatively well. Apple, for instance, is a very common example of this. If you don't have a framework for stock selection, it's going to be much more difficult for you to find success in the stock market over the long term. To combat this, try to be specific with your selection criteria to help better guide and narrow down the stock universe of investments to choose from. So I'll provide an example for me with my rough general stock selection framework. So while being a value investor that invests primarily in individual stocks, I do have some investments in passive index funds. However, regarding this, there are only 3 funds that I invest in. One is VOO, your standard S&P 500 index. 2 is VYM, a high dividend yield ETF. And 3 is VGT, an information technology sector ETF. All 3 with Vanguard with very low expense ratios. As a rough guideline, I try and keep the amount of money invested in each of these funds roughly balanced. And I use these 3 funds primarily as a benchmark for the rest of my value portfolio. Here are a few of the criteria that I generally look for when identifying potential businesses I'd want to own in my portfolio. One is I'd like to look for companies with consistent earnings growth over a long period of time. If the business is also recession resistant, that's a plus, but not necessarily a deal breaker if it isn't. Value is important to me, which is related not only to the business fundamentals, but also the price you pay, as I want to try and buy above average businesses at below average prices. Deep value and turnaround stocks are things I've invested in the past, but given the stage we are in the market cycle, I've shifted my focus to higher quality companies with a bit more earnings stability. The business needs competent and also shareholder aligned management, as well as having a moat or a competitive advantage of some kind. So hopefully that gives you an example of a rough stock selection framework. Now you don't have to be locked into your framework forever, and it can evolve and change over time. However, those changes should be deliberate and well reasoned, and not just to chase what seems like the next hot stock. Now we'll cover the second aspect of an investing framework, which is position sizing. This is actually an aspect of portfolio management that doesn't get talked about nearly as much as it should. Stock selection is relatively straightforward, in which you're narrowing down the companies that you want to own in your portfolio. But when you do find a stock you want to invest in, the question arises, how much should you invest in that stock, and how large a position should it be in your portfolio? Now, if you have more of your portfolio concentrated in a few stocks, your portfolio is going to be more volatile in price. Well, that's not a bad thing on its own. Most people underestimate the emotional impact that large declines in their portfolio can have on decision making. Having more stocks in your portfolio and or limiting the size of positions can help diversify the portfolio and help limit the impact of a single negative stock selection. The way I like to manage my portfolio is a bit of both. I manage my portfolio as a concentrated value portfolio and basically have 2 primary rules when it comes to the position sizing of my stock holdings. The first is that position size is limited to 8% of my total cost basis. The cost basis of my portfolio being the total amount that I've actually contributed and put into the portfolio. Once it hits that 8% threshold, I don't add any more to that stock. For example, let's say you've contributed $100,000 to your portfolio. It's now currently valued at $130,000. Applying this 8% rule to the cost basis means that you wouldn't invest any more than $8,000 in a single stock. While the first rule is designed for diversification, the second rule is designed for concentration and focusing your portfolio on your best or highest conviction ideas. To achieve this, I aim to have at least 80% of the portfolio of individual stocks I own to be concentrated within the top 6 to 8 stocks. Now, within those top 6 to 8 ideas, the largest positions are not necessarily the ones with the highest rate of expected return, but are usually the ones with the lowest risk of losing money. Now, oftentimes those 2 aspects are highly related. However, by focusing on not losing money, this can generally help limiting downside while still giving you the upside potential. Now, you might develop different position sizing rules, for instance, being a bit more diversified rather than running a concentrated portfolio. Or if you're investing in index funds, you can set up a rule deciding how much you're going to invest ahead of time in each fund. The key is to have written rules that help keep you in check whenever inevitably you're tempted to make an emotional investment decision. The third aspect of building an investment framework is market timing. And this is highly related to asset allocation, which we'll discuss more in just a bit. Now, you may have heard the phrase that time in the market beats timing the market. which is just another way of saying that continuing to invest in stocks beats pulling money in and out of the market over the long term. However, in my view, this is a very black and white way of looking at the subject. The reality is there can certainly be periods in time where it could very well make sense to scale back on some stock investments, and in other times to overweight your stock positions. For instance, that can depend on market valuations. 2009 was a fantastic time to buy stocks. Due to the fear and panic of the financial crisis, valuations were at much lower levels than they are today, and low valuations are correlated to higher rates of future return. And that's exactly what investors over the last 10 years who invested in 2009 have been able to benefit from. Now in 2019, there's still some opportunity, especially in some individual stocks, to see good returns with investing. But with overall market valuations much higher than they were in 2009, perhaps building up a little bit more cash would be prudent. Of course, there are many perspectives on this matter. For example, Peter Lynch, one of the best stock selectors of all time, always had his funds 100% in stocks 100% of the time. His reasoning was that if he's always fully invested, that's one less thing he needs to think about, and instead can focus the majority of his time on stock selection and business analysis. What market timing really comes down to is the following question. Are you willing or are you going to change your asset allocation over time? Asset allocation being the combination of stocks, bonds, cash, and other assets you hold in your portfolio, and what proportions. A strategic asset allocation is an asset allocation that is fixed in its portfolio percentages, invested to each asset class, regardless of market conditions. On the other hand, you could have what's called a tactical asset allocation, which can change over time in response to market conditions. Many people stick with a fixed strategic asset allocation, which oftentimes works very well because it gives you a non-emotional, rules-based system to follow. If you do decide to use a tactical asset allocation, where your asset allocation may change or vary over time, make sure you have a predefined rules-based system to it so you don't make changes based on emotional decisions. If you don't have predefined rules, you will likely end up buying high and selling low, the opposite of what you want to do in practice. As an example, I'll discuss my tactical asset allocation. The way I manage my portfolio, I have a fixed percentage always invested in alternative investments, or effectively non-stock or non-bond asset classes. This percentage will stay roughly the same over time. For the remaining stock, bond, cash assets, I have a tactical asset allocation based on market valuations. When market valuations based on broad metrics like the CAPE ratio or market cap to GDP ratio show the market is at lower than average overall valuations, in other words, a better risk to reward ratio for investors, then in my tactic asset allocation, I have a larger proportion allocated to stock investments. When valuations are higher than historical norms, I typically will hold more cash in the portfolio, which will then be reinvested whenever valuations come down, or when there's individual stock opportunities that have a lower and more favorable valuation than the average stock in the market. So right now my portfolio is fairly cash heavy and is about a 50-50 split between stocks and cash in the portfolio. The reason I hold cash instead of bonds is because at this time I don't think that bonds are providing sufficient return given their long-term interest rate risk, which is why instead of bonds, I'm investing in cash equivalent money market funds instead. If you want to learn more about money market funds, I'll leave a link in the video as well as in the description. Now you can choose and decide an allocation that you think makes the most sense for you. But to avoid emotional decision making, make sure you've codified it as a rules-based system. And now we'll get to the final aspect of an investment framework, which is risk management. This is another incredibly important topic that's also under-discussed. How do you manage risk in a portfolio? And to clarify, what exactly is the risk that we're trying to manage? Now, it might seem like volatility is the risk, but short-term volatility today isn't going to matter much for investors 5, 10, or 20 years from now. So the real risk for investors is something much longer term. And that risk, and the risk you should be managing, is the risk of not meeting your long-term financial goals. In the terms of portfolio management, I view this as a permanent loss of principal in your portfolio. Put another way, it's an investment you make in your portfolio that loses money and you never make back. Now, Howard Marks, a very renowned value investor, has stated that a permanent loss could occur for either of the following reasons. One is an otherwise temporary dip is locked in when the investor sells during a downswing, whether this is because of a loss of conviction, requirements stemming from his time frame, financial exigency, or emotional pressures. And the second reason is that the investment itself is unable to recover from fundamental reasons. He also stated that in the short run, it's very hard to differentiate between a downward fluctuation and a permanent loss. Often, it can only really be done in retrospect. We can ride out volatility, but we never get the chance to undo a permanent loss. So if you're a long-term investor, it's important to have conviction in your investments, and it shouldn't bother you if your stocks are trading down 20% if you know in 10 years that those businesses will still be continuing to grow. So if we know the main risk that we want to avoid is a permanent loss of principal, what are some tools or key risk management principles that we can use to help mitigate that risk over time? Well, one of the best and simplest risk management tools is simply the price that you buy each stock. All else being equal, the lower the price you can buy a stock, the less risky the stock is. Now that might seem counterintuitive, especially for a stock that continues to fall in price very quickly. However, remember that in the short term, the stock market can be a very emotional and volatile place. But for you as a long-term investor focused on business fundamentals, you're more concerned about the business's underlying performance. Take Apple for a recent example. Many investors were extremely fearful over slowing growth in iPhone sales during the end of 2018. This caused a significant sell-off in the stock price of Apple to much lower valuations than it was trading at just 3 months ago. At the time, there was a lot of discussion that Apple seemed like a very risky investment given the slowdown in sales for the iPhone. However, because of the significant price decline, Apple was actually less risky when the price was lower, even though uncertainty was at its highest. Investors who bought early 2019 didn't have to take on as much risk compared to investors who bought 3 months earlier at a much higher price. On the flip side, another tool for risk management is the ability to be willing to let go of a stock if you believe it's appreciated well above its fair value. Beyond Meat is a stock that I made a video about earlier this year, arguing that it was grossly overvalued. At the time, the stock was trading at $138 per share, but rallied even higher to over $200 per share. Now, investors applying good risk management would realize that the stock has simply run up too high compared to fundamentals and was worth actually a lot less than the current price in the market. Once investors started realizing this and the momentum began to shift, the stock began its long and gradual decline. Now, I wouldn't have recommended anyone buying Beyond stock to begin with, but for those who owned it, and this applies really to any stock at all, is that it's important to not just look at the stock price, but actually look at the underlying business fundamentals to determine what the stock is reasonably worth. If the stock price is way over that valuation, it would be a prudent risk management technique to sell and get rid of that position before the stock eventually comes back down to a fair valuation. So with all that being said, here's the rough framework that I use for risk management on the buy side. My primary focus is to not lose money. So this generally means waiting for a price that has a very favorable risk to reward ratio. So if there's a stock I want to buy, I will generally not buy on my full position all at once, but I'll scale in gradually over time if the stock price continues to fall further. Remember, all else being equal, a lower price means lower risk and a better risk to reward ratio. So I would be happy to increase my position at lower prices where both the risk is lower and the expected future return is higher. So here's a rough framework that I use for position sizing in my portfolio. If a full position is 8% on my portfolio cost basis, I might start a position with an initial 1% weighting. If the price were to fall further, increasing the likely rate of return and also simultaneously reducing the risk of long-term loss of principal, again assuming the fundamentals of the business are still intact, then I'd increase the position size to be more reflective of the more favorable risk to reward ratio. In addition to deciding exactly how much to invest in a company, it's important to also keep in mind conditions where you might not want to invest in a company at all. I have a list of potential red flags that I run through each of the companies that I'm thinking about purchasing. If any of these produce a concerning answer, I consider limiting the size of the position in advance or not purchasing any stock at all. So overall, that should give you a sense of just some of the risk management techniques and tools that are available to you and which you can build and incorporate in your own systematic investment framework. Having a defined strategy in place will allow you to make the best decisions possible and avoid the emotional mistakes that can harm most investors who don't spend the time building an investment framework. Overall, I hope you enjoyed this video. If you'd like a look into some of the tools that I use to manage my portfolio, you can check the second link in the description below. There you can download all of the custom spreadsheets that I use, as well as take a look into my portfolio. And if that doesn't interest you, that's perfectly fine. But definitely do consider subscribing, because in the future we will have some tutorials that go through how you can actually build similar spreadsheets to those and apply them to your own portfolio. Until next time, thanks so much for watching. My name's Michael, and I will see you in the next video.